Alright everyone, welcome back to more on technical analysis. What we're going to do in this video is take a look at some of the patterns that emerge when we're doing technical analysis with candlestick charts. There are easily 1,000 different patterns that could show up, but unfortunately a lot of them have been degraded by algorithmic trading, meaning that they're no longer useful to us. Hedge funds and other financial corporations that have a lot of access to resources can trade at speeds that we can't even come close to matching, meaning that some of these patterns that we look for only exist for a few seconds before a big player steps in and scoops them up and changes everything. Fortunately for us, we don't need to have access to 1,000 different charts. All we need is a handful of reliable patterns that we can use to give us an advantage when we're trading. So what we'll do in this video is look at the 5 most important candlestick charts that we might see emerge when we're performing technical analysis. Now keep in mind that when we're looking at these patterns, these candlesticks could be a day or a month, it doesn't matter. So let's get right into it and I'll show you the different patterns that we're looking at. If this doesn't make any sense to you, then I would encourage you to take a look at the first video on candlestick charts. Otherwise what you're looking at probably won't make any sense. And also keep in mind that I deliberately excluded all the tails from any of these candles just for clarity purposes unless it's important to the chart itself, such as with the evening star where it's important for us to identify these tails. Let's take a look first at the 3-line strike, which is one of my favorites. We're looking for a stock that's going along doing its thing, followed by 3 downward red candles, followed by, on the 4th day, 1 huge candlestick that blows away all 3 downward ones. What's happening here is that buyers have come into the market and reversed the pattern by driving it up past what it initially started at. When we see something like this, we're looking at an 84% chance that the stock will continue to rise, which is tremendous. This is a very, very bullish pattern, and when you do see it emerge, consider taking a long position on the stock, because it's very likely to continue rising. Keep in mind that the more volume you see, especially here on this 4th day, gives more weight to the pattern itself. If volume is particularly low, then this could just be a fluke. But when the volume is regular or strong, then it makes it more likely that the pattern will play out the way we expect it to. Again, when we see some volume, 84% accuracy rate. That's easily the highest of all of these, and you should definitely take advantage of it when you see it. The next pattern we're looking for is the evening star. So this pattern is bearish, meaning that it's likely that the stock will continue to fall after we see this pattern emerge. We see a stock that's doing its thing, and then it breaks to a new high on a long candlestick. On the 2nd day, new buyers don't come into the market. So even though the stock has risen substantially, there's nobody new coming in to buy it. And when you think about it, that makes sense. After the stock shoots up like a rocket, people are going to want to take advantage of this opportunity and sell while the prices are high. So on the 2nd day, we might see a little bit of fighting going on, which is why we look for these tails on our candlesticks. But ultimately, the stock price does not continue to rise. So people are coming out of the stock, and then on the 2nd day, or rather on the 3rd day, we see that there's a 3rd long candle, this one downward, meaning that people are bailing out and they're taking advantage of the higher prices while they can. And once that happens, it really causes this kind of downward snowball, and we're looking at the stock price continuing to fall until it reaches another point where it can stabilize itself. When we see a lot of volume, especially here on the 2nd and 3rd days, this can push the accuracy rate of this up to 72%, meaning that it's better than, it's almost, you've got almost a 3/4 chance of this being accurate. So when you own a stock that does this, when you see this pattern emerge, it's worth considering getting out while you still have profits because it's likely to continue falling. Let's take a look now at a 3rd one. This one's called the abandoned baby. It's got a very strange name, but ultimately it's a bullish pattern, which is essentially the opposite of the evening star. We see a stock dropping, and then after a significant drop, the stock price stabilizes itself. We see some fighting going on, and ultimately there's not enough people selling the stock anymore because it's dropped so substantially. We see here that people are coming into the market, they're fighting over the stock price, but ultimately we don't see another low. Or rather, we don't see the stock price continue to fall substantially on that day. It's balanced out. And then we look for the 3rd day when the stock price rises. It's at this point that we know that we're likely to see a continued rise. So we're looking to get in around this point. between this day and this day. If we get in at that point, we've got a 70% chance that we'll make money on any long positions because the stock will continue to rise. Again, we're looking for volume. If you don't see any volume, then this candle right here could just be a fluke, just kind of a weird day. If we see substantial volume, or at least volume that's consistent with the average, then it lends more weight to the pattern itself. The three black crows is a pretty terrifying pattern for anybody who's long any positions. We're looking for 3 red candles that drop substantially with small tails down on the bottom. What this indicates is that people are fleeing the market, and there's very little cushion underneath, very little buying that's buoying it back up. So the stock is dropping, there's nothing underneath it, there's no floor for it to bounce off of because people just aren't buying. So if you see 3 straight days of this, long red candles with no tail down the bottom, then the stock price is likely to continue dropping substantially. And when you see volume, then you know that this is a clear panic. People are just fleeing and getting out of the stock while they can. With 78% accuracy, we can assess that these 3 candles on high volume indicate that the stock will continue dropping. Here's another one called 2 black gapping. Another kind of strange name, but in any case, it's a bearish pattern that includes a stock dropping marginally, not significantly, on the first day, followed by a huge gap downward on the second day. Sometimes gapping, if you recall, happens when there's bad news or some kind of other omen that's happening in the market, people are getting out. But often when the stock gaps down, people will buy while the price is low in order to continue taking advantage of the low prices. Instead, in a 2 black gapping pattern, we see the stock price drop, and there's nobody underneath it that's buoying it up. Nobody's holding it, nobody's buying it. Instead, the stock price keeps dropping. So if you see 3 straight days of this on substantial volume, then the price is likely to continue dropping. 68% accurate. So these are some textbook examples. They're very rarely quite this clean when you're looking at them in practice. So what we'll do now is take a look at the stocks as they trade in real life. These are fairly live. This is as of today on June 15th, 2017. Intel is trading at 35.31. Now there's a whole bunch of congestion going on right now, but if we take a look a little bit further back, we can see some patterns that have clearly emerged. The first one, we see 3 black crows right here. 1, 2, 3. We do see some tails down on the bottom, but it's very clear that the stock is dropping and there's just not enough volume to keep buoying it up, and it keeps making these lower lows. So even though we do see some volume happening on the next day, these 3 candles together indicate that we're probably looking at a lower low coming in the future. And lo and behold, we see it happening right here. And stock drops down, it looks like about another dollar and change. But here at number 2, sometime in the middle of February, we can see that an abandoned baby forms. We see a long red candle, and then on the next day, since the stock price has dropped so substantially, a lot of buyers are coming in. We see that it's unable to make a lower, well, it makes a lower low, but it doesn't come anywhere near the same magnitude that we had seen on previous days. So the stock price has dropped throughout the day, which is why we see that tail, and then buyers are coming in, pushing the price back up, ending pretty much, in fact, a little bit higher than where it opened. And now if we look again on this 3rd day, right here, then we can see that the stock price has risen, and it'll likely continue rising just because buyers have come into the market. And if we look here, we'll see that it rose about $1 and change again, pretty much to where it was right before the abandoned baby had started. All right, let's continue on now. We'll take a look at AT&T. We see a good example of 2 black gapping right here, where the stock price has dropped sometime in the beginning of April, and we don't see any candlesticks with significant tails underneath. So that's indicating that the stock has dropped and there's a little buying power that's pushing it back up. The stock it's just gonna keep rolling downhill until somebody starts buying. We see some leveling off, but then it just continues downward all the way down. It looks like it drops about $3, or rather $4 from when the 2 black gapping pattern started. So when we don't see candlesticks with tails and volume is at least average, then that indicates to us we're likely to see a continued downtrend until we see a reversal pattern. Let's move on now and we'll take a look at 3M. We first see a 3-line strike. It looks like it happened somewhere in the beginning of 2016. This pattern is fairly hard to find just because it's so powerful that it doesn't appear very often. But we do see right here 1, 2, 3 red candles followed by one strong green candle that just blows the other 3 away, which indicates that significant buying has come into the market. People are picking up this stock while they can, while the price is still low enough. And lo and behold, it continues rising substantially. What's that, $30 since the pattern actually started? Yeah, a little more than $30 before it starts leveling off again. And we can see here at number 2, a long red candle followed by a short candle with tails on either end. In fact, this is called a doji. Sorry for not pointing that out earlier. A doji has formed here, followed by a long green candle on the way up, which indicates that people have come into the market and started buying again. And look here, the stock price continues to rise. And as of today, June 15th, 2017, it really hasn't shown much sign of slowing down yet. So when you see patterns like this, the 3-line strike and the abandoned baby, know that they're powerful patterns, and you can take advantage of it when you see it. So that just about rounds it out. We've got one more to go through. We see 2 examples of the evening star here on Dominion Energy. We see one long green candle followed by this doji forming here, where although the stock has risen, it fails to ultimately close at a new high, meaning buyers aren't coming in. They're just taking advantage of the higher prices and selling. And on the next day, when we see a red candle, prices are going to keep lowering. And in fact, they do go down several more dollars before reversing again. And then we see once more here on number 2. It's not quite as clear as it is over here, because we typically like to see this doji at least gap up slightly from the previous close. In our case, it doesn't. It kind of just stays flat, lined up with the other ones. But in any case, we can see that it definitely fails to make a new high after one long green candle. There's a red candle that shows you that it's going to push the price back down, and indeed, it goes all the way back down. It looks like about $65 before reversing again. And then finally, over here at number 3, we see a 3-line strike. It's not quite as clear as it was in our previous chart, but we do see 1, 2, 3 red candles followed by one green one that obliterates the previous 3, which shows you that the price is going to start rising again. And it went up a few more dollars, about $3, before it leveled off and started reversing once more. So that just about closes it out. I just want to emphasize one more time, it's very, very important that when you're looking at these patterns, you're looking for volume. Here the volume stays pretty static across, so you don't really have anything to worry about. But if this volume here were particularly low, people really weren't trading it, it could indicate that the pattern that we're looking at is just a coincidence. The more volume we have, the more likely it is that the pattern is going to play out the way we expect it to. So I hope that was helpful to you. When we come back, we'll continue our lessons with technical analysis. Until then, happy trading.